Welcome to Behind the Doors, the podcast where we take you behind the scenes of residential real estate investing. I'm your host, Dan Noma Jr., here with my co-host, Marvin Cruz.
We're here to help you unlock the best strategies and practice for investors. Whether you're just starting out or you're a seasoned pro looking to scale your portfolio.
We've spent decades navigating the ever-changing world of real estate, and now we're sharing everything we've learned to help you succeed.
From off-market deals to cash flow management and everything in between, we'll break it down and bring you actionable insights that can make a real difference in your investments.
So get ready to open the door to new opportunities and take your real estate investing to the next level. Let's dive in.
We are back for another episode. I still don't have my voice. Still not there yet. But that's all right. We're still going to battle this one through. How are you doing?
Good, man. I'm good, man. I'm good. Glad you're back, though.
I'm so happy to be back, man. I know I missed you.
Even if we got 90% of you, it's still good.
I appreciate it. Man, I got another touchy topic to talk about. And I love touchy topics, by the way, because this one is just, the world feels this one. And then what I want to talk today about is recession. And why people get nervous and why people panic, and rightfully so, right? Because there's a couple things that happen during the pandemic, right? Economy slows down, so people get nervous. Job losses rise, so people get nervous. And then your credit gets tighter and people get nervous, right? But you know what's interesting that does happen? Something positive does come out of a recession, and that's home prices dip. Mm-hmm. So let's talk about that from an investment standpoint. So why is the pandemic good for investors?
I think
not pandemic,
the recession. I mean, a recession, right? Like, I think it's like people look at recessions and they immediately look straight to like unemployment as the only thing. And then they panic and go, well, it means that people aren't going to be able to pay their bills. Yeah. Okay, but there's a certain percentage that's going to happen to. Sure, that's the reality. But like, really, to make a recession, right? There's kind of like four or five big indicators, right, of a recession. And if you think about those indicators, like there's a conference board, and they have this what they call the leading economic index, right? That LEI number is something to just keep an eye on. Okay. As that number drops, right, that's a pretty good signal that we're gonna slip into a recession, right? And so that number in the last year has slipped almost 4.5%, right? And so that's one big signal to look at and go, okay, this is we are in a recession. So I think like people go, what, are we actually in it? My neighbor lost their job. Does that mean we're in a recession? Right. No, not yet. Hang on, right? The next one would be the inverted yield curve, right? That one, I think we did an episode where we talked at length about like, short-term treasury yields and like why this yield curve is important to watch. Every time we have had a inversion of that yield curve, since 1981, it's led to a recession every time. So it's a pretty strong indicator, right, that like this was unavoidable to some degree. And so, we can get into why, but I think that the third thing that I think people could look at is the unemployment rates, right? As that unemployment rate goes up, that's also another strong indicator that we're going to be in a recession. And, when you think about like what kind of jobs, because I think that's one that gets missed too, right? So if it's like tech jobs are different than farm jobs, right? And so they do keep track of what they call non-farm unemployment rates. And so that non-farm unemployment growth number, if it's not growing, that's a problem, right? And so that's something that, we need to consider. And then in general, right, they're constantly surveying consumers and going, what's the consumer confidence index at? Like, what is that confidence thing? And right now, like, it's fair to say 2 consecutive quarters, we've been in this. Therefore, we are in a recession, right? And that is a real thing. But it isn't all bad. Like to your earlier point, like that isn't all bad.
Let's talk about that. Why is this good for investors?
Yeah. Well, what's interesting is like what you said a minute ago is you were like, the home prices typically fall in a recession. The last two that they didn't, like home prices they didn't adjust. So I don't know, too early to tell if home prices will be affected by the recession. And the reason is, right, is we just have we have a big supply problem still. There's like somewhere in the neighborhood of 3 million homes, like shortage in the US. So people with that kind of a shortage, it makes home values sustainable, right? They're willing to pay for a property because they need a roof over their head. Like it's an essential. We got to have it. And we're short 3 million of them. That's going to be a supply and demand thing, and so that's less recessionary. But I think what happens in a recession though is you start to have like job losses, inflation start to shift, credit to your point gets tightened, in home values, correct, incorrect, whatever, but interest rates are most likely not really moving a whole lot anyways. It's just expensive to buy real estate, and where are folks going to go if they're not going to go and buy a house? They're going to have to rent. And, who better to buy those rental properties than us and make sure that these people have safe and, affordable homes that they can live in. Because today, it is more expensive to own than it is to rent. And I say that and people are like, what are you talking about? I'm like, how is that could be? Well, you're not every year are you going to get 38% appreciation on your home, right? I mean, you're going to have years where you don't have any. Right. And we're probably getting into that, right? Last year, I think it was like 1 or 2% across the board. I think this year we're kind of factoring the same. We're not seeing a whole lot of like equity growth in these houses. Home prices are kind of stabilizing. Okay. And now the cost to repair these homes has gone up, right? As inflation's caused that to be a thing. Add the tariffs into that, and that now like the cost of paint goes up. Everything goes up as a result. And then you have less access to your credit, to have this giant mortgage out there. So, there are just situations and people that probably shouldn't buy houses, and that's okay. It's not what it used to be, right? It's just not what it used to be, and to own a home versus rent.
I love what you just said there because, I think what I hear you say is good for investors. One is you'll have a more motivated seller, right? Yeah. So you're going to get even discounted prices. Yeah. You're probably going to get less competition as well. Yeah. But you just touched on something. You're going to get more people that want to rent. Yeah. Because it's actually cheaper to rent. So it's a all the way around success for an investor during these two periods. Yeah, it's like in our business, right? We see, so let's say on a given day, we see 350 off-market submissions into our platform, right? Of that 350, we only see 35 of those people on average that actually come back to us and go, yeah, I'm interested in selling my home for cash. Right. Okay, well, cool. That means that 90% of these people, they all went out and did whatever they're going to do with their property, whether it was hold it, sell it, whatever in the retail market, they could. But for that segment of the consumer that's got to sell, who needs to sell and wants to sell fast, it wants to sell now, wants to sell with less friction, wants to do all those things, that's where the opportunity lies. And like, how else do you filter that and get that opportunity to the top if you're not making thousands of offers to them to find those 35 opportunities, right? And that's what we do. And this is the time that we do it in as a result of, because now we're going to know and identify who's the most likely seller that really has to sell or wants to sell, right? And that's where we come in as an investor and go, yeah, we can buy that property, right? Again, like we talked about in our last episode, I don't want to go compete with a retail buyer on the MLS for a property. When I've got a motivated seller, I can give them something. It's a win-win situation when that it works out that way. So it's not like cash offer is a new thing either, right? This has been going on for every cycle, every year, all the time. Like this has just been a consistent thing. So pretty good opportunity for sure. No, that's 100%. So, and rental demand is even increasing. Yeah. So this is a positive as well for investors. But Why is it increasing? What are your thoughts on why rental demand is
Yeah,
increasing?
I think, well, obviously it's harder for people to get a mortgage.
Yeah.
I mean, you
Expensive, it's
yeah, I
harder.
mean, yeah, there's FHA options out there,
Yeah.
and there's, these options that, will pay for part of your down payment, down payment assistance programs and stuff like that. But your traditional conventional mortgage is 20% down.
Yeah.
And then you got closing costs that go along into that. And then if you look at the housing stock, what's interesting is like in a market like we're in Phoenix, the stuff that's trading on the market is nice. It like has been updated. Most investors have gone in and like flipped those homes. That's the inventory that's selling. The stuff that's not selling is the stuff that has a little crunch left on it
Yeah.
and, needs a little work because people are going, okay, I got to come up with my down payment. I got to come up with my closing costs. Then I got to furnish it, move into it, and then I've got to repair it too. I don't have all of those funds,
Yeah,
right? And that's where you start to see that those properties that need a little love are less interesting to the retail buyer and more likely to be sold to an investor because they can make a little spread and sell them and fix them up and clean them up so that the property's just bam, move in ready, and that's a great option.
Yeah.
Yeah.
And then you still have the uncertainty. Folks are still nervous.
Yeah.
They're still on the fence, so they don't want to buy. They rather just rent
Right.
just in case something happens. But well said, because a lot of times you don't think about that. You want to buy a certain home that comes with a big down payment, but you also want to fix it up. You also want to furnish it. You want to buy new things for it, but that's a lot of cash flow that you have to have. So
And it's gotten expensive, right?
yeah,
It's like,
everything's gotten more expensive.
you go to Home Depot, you want to put in like a garden in your backyard. Good luck. Like it's not going to be cheap. It's you're still going to spend some money doing that. It's not, those little things are not cheap anymore.
Yeah.
So, that those little nice touches that you can make to your home, none of that stuff is cheap.
Yep. So if I'm from an investor standpoint, I'm thinking about rental demand is still very high.
Yeah.
And people always, guess what? They always need a place to live.
Yeah. Right.
It's not like we don't need a place to stay.
Yeah.
And I would think of it differently as an investor. Not only could you succeed from a financial perspective, but I think you're actually helping people because we all need a place to stay.
Yeah.
Yeah.
Yeah, for sure. And I think that, rent prices have been pretty resilient, and especially in recessionary cycles too. Because it's, typically a percentage of like household income is how rents are determined in a given area. So they're following kind of that household income trend. And so it's not like home prices where home prices like get super competitive and whatnot, and people are bidding against each other, and you're seeing, properties bid it up that way. They're pretty stable, right? I mean, they do have some growth to them. Like it's fairly easy to say you could see like a 2 or 3% increase in rental rates, but now we're talking about increase from going from $1,900 to $2,000 a month versus like buying a house for $350 to $450 the next year, right? That's a big jump. So, while 3% sounds like not a lot, when you're talking about hundreds of thousands of dollars, it becomes a big thing. It's a bigger number for sure.
All right, so I'm an investor. I hear you, Dan, right? The rental's going up. There's plenty of opportunity there for me. I'm prepared. I'm ready to move forward, but I need to work on my interest rate, or maybe there's some other creative financing. Can you talk to the investors about, are there other creative financial tricks that we could do to go get more rental properties?
Yeah, I mean, DSCR loans. I think, next week we've got somebody coming on that we're going to talk at length about DSCR. So I'm not going to dive too deep into that, but we're talking about is debt coverage ratio lending, right? So basically they're looking at, does the tenant pay enough in rent to cover the payment to me as the lender? And if so, how deep does that discount my rate? And could I do this a little bit cheaper? Right. So, I mean, we're seeing DSCR rates as competitive as like conventional mortgages now. So those are awesome opportunities for people to buy a property, stabilize it, and then get one of these DSCR loans, get cash out, do whatever you want to do, whether you do the BRRRR or you keep your equity in the property, whatever you decide is fine. Right. But look at those DSCR options and get some leverage because, we're talking about 6 to 7%. I know it sounds crazy. People are like, oh man, well, I have a 2% mortgage on my house, a 3% mortgage on my house. That was such an anomaly. How many real estate agents did you see go date the rate? Right. Like they're all just eating their words at the moment. And that's a lot of those that were kind of thought about this through, and we're going, man, we may never see those rates again in our lifetime. We likely won't, right? So short of a pandemic, hang on. Real rates are probably in that 5 to 7% range. And that's where the market can nail it. So get comfortable with those. And same with the investors. You're not going to see, second home or investment rates drop into the 3s and 4s. That just is unrealistic. There is no reason to see that. So I don't know. It's a long-term game, right? And I think you got to make sure that you're playing that game. The creative finance is different. And we're seeing a lot of this right now. The warning I would kind of give to everybody with creative finance is find an attorney or find somebody that does this well and does this completely above board. Because it can get really tricky. These seller carrybacks and wraps, and you see subject to deals and stuff like that. Not that they're all bad. I'm not saying that, but I'm just saying they can be.
Right.
A lot of the people doing them are undereducated about them, and it becomes a lot. It comes with a lot of challenges. But just think about how much equity people have right now. $17 trillion of equity sitting in their homes, right? Something like that. If you could find people that own their homes outright and would finance you, now that person, instead of making just the equity and getting it all back and then figuring out how they're going to go and redeploy the money, they could stay in the deal. You put 20% down, 10% down, whatever, and let them carry the rate.
Right.
Let the seller carry the rate, because now the seller can earn 8% on their equity while it sits in the property and it's fully secured by real estate. So the seller carry deals are not bad, right? Those are not bad. Now the seller carry deals where there's a mortgage, that's where it gets interesting. That's where it gets sticky, right? There's most mortgages have what they call a due on sale clause. It means when you sell the property, you have to pay the bank back, right? That's just part of the process. But what they're doing is they're selling essentially the deed and keeping the mortgage in place, right? So now the old homeowner still maintains the mortgage. The new buyer comes in, they now control the deed. So the new homeowner is now potentially putting themselves in a situation where if this guy doesn't pay the old mortgage, you're going to be stuck with him. And you got to be in the right position where you could carry multiple mortgages, or you just don't need another mortgage again or anything else, because that mortgage is still going to show up in your world. It works. It's not a bad thing. It's not. It just is unique. And you got to make sure that the paperwork is tight and totally legal, because it can be. And I think it's important. We see a lot of them that aren't, and that's where it gets predatory, and so I think you got to be really careful with some of this creative finance stuff that's going on.
Yeah. So, when you think about this topic today is the recession, there's a couple of things. So one, Federal Reserves, when they in the recession, they will lower the interest rate. That helps investors a little bit. Lower rates mean cheaper financing for investors as well. But I love what you were just touching on. There's also a little bit of other tricks. Seller financing is one of them. Assumable mortgages is another one. And then you can also get private lending and other partnerships and syndications and join other groups to make it a little bit easier for you as well. By the way, are you involved in syndication at all, right? So I think that's another awesome opportunity for folks as well, right? Where you don't need as much.
I choose to syndicate outside of my comfort zone. So if I'm not familiar with it, then I'm going to go and syndicate with an expert, because I like to diversify a little bit. So for me, in the last few years, I've been diversifying into industrial. I know enough to be dangerous about industrial, truly, right? And it's just not a market that I studied as well. But I've got a friend that did, right? And he very much understands industrial. And so I invested in his fund, to diversify a bit. But I don't need to know everything about industrial. He does, and so I trust him to do that.
Right.
And so
Love that. Love that. You always say this: real estate investing is a long-term game.
It is, man.
Right. And the one thing that I will say about a recession is, you know what? One thing that's always true is home prices always recover.
Right.
Homes always recover.
Yep.
Right. So
Yeah.
I love that you always talk about that. But so you buy low in a recession,
Yeah.
and then what? You just hold on to it, rent it out. How long?
That's it, man. I mean, I think that, the strategies could be everything from, buy and hold long term, right? Get the right debt, continue to look for better debt. And when you get better debt, then just put better debt on it. But keep that property. And as long as it breaks even or cash flows a little bit, that's a great opportunity, right? That is a great opportunity.
Love that.
Lock in rates when you can, right? If you see opportunities to rates that look really solid, these DSCR opportunities and the rates at 6.5% and it's a solid deal, lock it in, right? Don't float a rate. Go lock that darn thing in because they may not see them again, right? And so just be careful, like go ahead and start locking some of that stuff in. But then I think it's like you've got to make sure that you're buying in areas where you can minimize your risk a bit. We saw this like in the kind of early 2000s-ish, right? Like 2006, 2007. What started happening is like home builders were building communities way outside of town. And the reason they were doing that was because home prices were going up so fast that, you couldn't really afford anything in town. So we used to say as agents, we would say, well, you drive till you qualify. So you drive out there until you can qualify and afford the home. Well, investors were doing the same thing. They were like, well, I'm going to go out there and I'm going to speculate on these areas too. The challenge was, though, is that there was so much of that, so much speculation, that the minute that the market adjusted and all of a sudden the home prices didn't go up like crazy, those areas just became less desirable, and finding tenants and occupants for those properties was hard. And, they were looking for discounts to live out that far, right? Because otherwise they just weren't going to go. So I think the recession offers a unique opportunity for investors to really lean into like the data and analytics and understand like where I should buy and why I'm going to be there. And how do I mitigate some risk by buying in areas that are less likely to be, have some recessionary conflict as a result.
I love that. So, let's just wrap up with the recession, because if I'm an investor, all I'm hearing today is this is a gold mine for me.
Yeah.
Right. It's on so many fronts. Not only am I going to get it cheaper, motivated seller.
Yeah.
More people want to rent the home. And it's going to recover.
Right.
Right. So I love that.
Yeah. The opportunities are abound us. And I think it's important that investors, it's always been buy low, sell high. That's always been the game.
Yeah.
Well, even though the adjustments may not be dramatic, let's look at them. Let's dive in and actually make strong and educated decisions, because you can, and there are options now versus like just seeing one or two properties and having to pick one of those. Like now you can see 20 and pick one. That's going to be awesome for you.
Yeah.
So that's a great opportunity for an investor right now.
Yeah, and I also saw where it says somewhere like the best investors buy when others are scared.
That's right, man. That's right. Yeah.
Yeah. So fear, I think it was fear versus opportunity.
That's it. That's the game. Yeah. It's not for the faint of heart, for sure. But if you've got a little, like, as long as you can lean into data and you can lean into the analytics and, look at trends and understand like what markets look like, instead of like, I guess the caution that I'll throw out there is don't just take somebody's subjective opinion of what they think the market's going to do.
Yeah.
Let's just like, this is the time even more now than ever is to lean into data and look hard at the data in your due diligence periods, understand rental rates, like understand economics, like what's happening in that neighborhood. All of those things are going to matter if the sky turns purple.
Yeah.
So let's know those in advance and minimize the risk and select the better opportunities as a result of risk. That's my 2 cents off my soapbox.
I swear I was going to close with that. I was just going to say, what should people start doing to prepare?
Right.
and I hear you loud and clear, is start researching now.
Yeah.
Understand data now.
Right.
So that when it happens, you're already 5 steps ahead of the other investors, right? So,
yeah, absolutely, man.
love it.
Thanks for tuning in to another episode of Behind the Doors. We hope you found today's insights valuable for your real estate investing journey.
Remember, real estate success doesn't happen overnight, but with the right tools and strategies, you can build long-term wealth and create passive income.
If you enjoyed the show, be sure to subscribe, leave us a review, and share it with others who are passionate about real estate investing.
Don't forget to follow us on social media for more tips and exclusive content.
Until next time, keep unlocking new opportunities, and we'll see you on the next episode of Behind the Doors.